The housing shortage is a massive problem for many Canadians, but what if I told you that there is one way on how you could generate a ton of money from it? Today, I'll share with you an easy way on how you can invest in real estate without having to put hundreds of thousands of dollars upfront. So I'll share with you 3 of the best Canadian REITs that you can buy right now for the long term. But first, before to see what are my picks, let's quickly recap what are REITs. A REIT, or a real estate investment trust, is a company that owns, operates, and finances different real estate properties. By being traded on the stock market, these types of companies gives you the possibility to invest in real estate for a fraction of the true cost that you would have to pay normally. By holding different REITs in your portfolio, it makes also that you don't have to deal with all the problems that comes with tenants, and at the same time you still receive over 90% of the total taxable income of these companies. Now that you understand what a REIT is, let's take a look at my pick number 1. The first real estate investment trust on my list is the Canadian Apartment Properties with the ticker CAR.UN. This REIT that is currently worth over $8 billion is currently the largest real estate investment trust companies of its kind in Canada. Indeed, by owning over 64,000 apartment units, townhomes, and manufactured home communities all around the important urban areas in Canada and in the Netherlands, it is by far the largest residential REIT in the country. Add to this with an occupancy rate of over 98.5%, this is showing that it is an essential REIT for people, because in fact to have a roof over your head is a basic need for everybody. This makes that compared to, for example, the commercial REITs that have been facing quite a lot of difficulties, notably with the pandemic where many stores have been closing, where this type of residential REIT is there to stay to continue to collect the rent of their tenants. Plus, with the current housing shortage problem that we have over here in Canada, and where the situation is getting far from being better with the project immigration that is predicted for the next couple of years, it makes that a company like Capit that has many thousands of different properties all around the country has a non-neglectable advantage on that side. Furthermore, in their latest earnings report, we've seen that the Canadian Apartment Properties has seen some important growth of 7% in both their operating revenue and their net operating income. And in the case that we want to find what is the true intrinsic value of real estate investment trust, well, we won't be using the traditional metrics such as the price to earnings ratio, but instead we'll be using, for example, the price to FFO ratio. The FFO, or the funds from the operations, is simply the cash generated by the company when it comes to their regular real estate activities. On their side, Capit currently has a price to FFO ratio of about 25, which is showing that the company would currently be quite fairly valued. At the same time, the current net asset value of this company is estimated to about $9.22 billion, and with a current market cap of about $8 billion right now, this would represent a current potential upside of about 13% at the moment. Plus, when you want to invest in these types of companies, you are mainly investing in them because of the high dividend income that they are able to give to you, because in fact all REITs must distribute at least 90% of their total taxable income to their shareholders in the form of dividends. And so for these types of companies, we won't be using the classical dividend payout ratio to find if the dividend is sustainable on the long term, but instead we'll be using the FFO payout ratio, and in the case of Capit with an FFO payout ratio of only about 57% at the moment, it is showing that the company could easily be able to increase their dividend over the next couple of years if they wanted to. However, in the case of Capit, we can see that they are pretty careful with the dividend increase that they are proposing, since we can see that the last one came back to 2021. But the Canadian Apartment Properties is still giving a great monthly dividend of about 3% per year. So on your side, if your dream would be to have different apartment units, but you don't want to have to manage all the tenant problems that comes with it, well, these types of REITs could be optimal for you. Now jumping out to the second pick on my list, I have the First Capital Real Estate Investment Trust with the ticker FCR.UN. This real estate company based in Toronto is also one of the largest REITs in the country, with over $7.3 billion of assets located in over 142 neighborhoods in the country. On their side, First First Capital mainly owns, operate, and develop grocery-anchored open-air centers in neighborhoods with the strongest demographics in Canada. So, as you can understand, this REIT is also investing in essential parts of our economy by trying to develop and to invest their assets in thriving properties and thriving communities. In terms of their largest tenants, you can find well-known companies in the food sector, for example, the food retailer Loblaws as the largest one. And you can also find other well-established companies such as Sobeys and Metro. In that way, it makes sense that grocery stores only by themselves represents about 17% of the total net revenue of this company. And after, you can find other great essential sectors such as the personal and medical services, the chains and cafes, and the other necessity-based retailers. And so by having some tenants that are pretty much offering some essential products and services to their different customers, it makes that this type of companies doesn't tend to close often despite having a slowly lower occupancy rate of about 96.3% compared to Capit. However, in terms of their net operating income, despite having seen some incredible growth in 2021 and in 2022, we've seen that their net operating income hasn't been growing as fast in 2023, where it has grew by about 1.3% year over year. However, considering the current net asset value of this business of about $4.6 billion compared to a market cap of about $3.4 billion, this would represent a massive potential upside of about 26% for the investors. Plus, with a price to FFO of only about 13.19 at the moment, it is showing that the stock would currently be quite massively undervalued. In terms of the sustainability of their massive 5.40% dividends, we can see that with a FFO payout ratio of 73%, well, it might indicate that the company might have some difficulties to increase it over the next couple of years. Nevertheless, at the moment, this small REIT compared to Capit could be quite interesting and quite undervalued, which could be a great alternative for the investors looking to invest in different grocery stores. Finally, the last pick on my list for the best Canadian REITs to buy right now for the long term is Granit with the ticker GRT.UN. This REIT that is focusing on the acquisition, the development, and the management of industrial warehouse and logistic properties in North America and Europe could be another wise choice for many investors. Indeed, with an impressive portfolio of over 143 properties spread around Canada, the US, Germany, Austria, and the Netherlands, it is fair to say that it is one of the most geographically diversified REITs in the whole country. On their side, with an occupancy rate of 95.6%, we can find that one tenant represents 25% of their total net revenue, and it is the company Magna. This is one of the largest Canadian businesses, and its operations consist of creating and assembling different automotive systems for cars. After it, we can find other great quality tenants such as Amazon, Mars Pet Care, and True Value Company. It makes that the company has a quite well diversified portfolio of tenants, which also reduce the total risk of non-payment of the rent. In terms of their net operating income, we've seen that they've been able to grow pretty well over the last year, where they've grew of about 8% year over year. And on its side, the net asset value of the company would be of about $5.3 billion compared to a market cap of about $4.8 billion. This would represent an upside potential of over 10%. Plus, with a price to FFO ratio of about 15 at the moment, it would also represent a pretty good entry point for many investors at the moment. Add to this, Granit is also paying a great monthly dividend payment of about 4.30% per year, and with an FFO payout ratio of 63%, it is showing that the dividend is still quite sustainable on the long term. As you've been able to see in this video, with the current macroeconomic conditions with some super high interest rates, this has caused many difficulties for different Canadian REITs, notably when it comes to the interest payments that they are paying from their mortgage. However, even if these companies that are known for their high debt are currently facing quite a lot of difficulties, well, since the interest rates are predicted to slowly start to slow down, it makes that these types of companies could see some pretty good exponential growth afterwards. However, while waiting for the interest rates cut that might be coming in 2024 or at the beginning of 2025, these types of companies are still able to offer you some great dividend payments pretty much every single month. So these options could be pretty interesting, especially for older people that are looking for great and steady flow of dividend income. But on your side, if you're looking for another way to diversify your portfolio and to invest for the long term to maximize the capital appreciation of it, well, check out the video that's gonna be right over here, and I will see you soon. Peace!